Hello and welcome to this session in which we will discuss the role of corporate directors or the board of directors in a corporation. The first thing we want to know is, how does the board of directors comes into existence? Well, we looked at this in the prior session when we looked at the role of shareholders. The shareholders, what do? They vote this group. They basically select them. Every year they can vote and they would select who they want to be on the board of directors. And once they select them, this group oversees the corporation. Oversees means they don't manage it. They have no management authority. They oversee the whole process. They vote as a group on matters that's important for the corporation. We're going to see what these matters are. But the overall role, if we want to summarize it in a moment, is overseeing the management and overseeing the company's operation, but not managing day-to-day operation. Let's take a look at specific roles that the board of directors play in a corporation. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. 1. They are responsible for choosing and overseeing the company officers. Well, who are we talking about here? We're talking about the CEO, the CFO. They assign top management, which in turn assigns or hire VPs and lower level management. They can remove them. In other words, they can fire them as long as there's a cause. They can evaluate officers' performance. Officers are the top people that work for the company, and as a result, they can remove them with or without specific cause. But if there is no specific cause, they may get a lawsuit. They can play a crucial role in shaping and changing the bylaws of the company. Remember the bylaws, we talked about them when the corporation is formed. Those are internal documents. They can create the bylaws, modify them, annul them, cancel them, create new ones. It does not matter. And they will determine the compensation for management. That's quite a bit of responsibility. The bylaws tells you how the company is run. The compensation is how much each individual will be paid. Also, they play a crucial role in initiating significant changes to the company's structure, merger, acquisition, anything like that. But on those major changes, they also need the shareholders' approval. There must be a vote, a majority vote. So for example, if there are 20 board of directors, the majority has to be there for the voting to take place. And within that voting, we have to have the majority, unless they specify otherwise. Also, they play a crucial role in dividend. When we talked about dividend, what we said the board of directors declare the dividend. The board of directors has the exclusive right to declare it. So even if the company make billions of dollars in profit, the corporation don't have to pay any dividend unless the board of directors decides to do so. The board holds the exclusive power to declare shareholders distribution, which is dividend, whether that's cash or stock dividend or whatever term of dividend. Now, if a distribution violate legal boundaries, what does that mean? It means if there is any type of debt covenant where because of the debt covenant, the creditor, the banker imposed certain rule on us. We violated those rules, or we declared enough dividend or too much dividend where we don't have enough cash to operate. Then the board of directors, they can be held personally accountable for this excess amount, what was legally permissible. Legally means they violated the rules here for the corporation. However, the directors can invoke the right that they rely on certain defenses, and they can seek reimbursement from shareholders who knowingly accepted unlawful distribution. So if they relied on the financial reports, they can sue and they can try to say, well, we did what we're supposed to do. Nevertheless, they owe a fiduciary duties to the company. What does that mean? They must prioritize the company's interests over their interests. If you are a board of directors, well, you have to look at the interests for the company. You are in charge. That's why the shareholders voted you to oversee the company. You cannot look after your interests. And this principle best judgment rule. This principle that protects directors who act in good faith. Now, you don't know what's the best thing for the company. You're going to use your judgment, your professional experience. That's why you were voted in, because you have plenty. People on the board of directors, they were senior executives in other corporations. They have plenty of experience. They're successful entrepreneur, well-known, successful people. Nevertheless, even though you have 5, 6, 7 people or 10 people with all this experience, they could still make mistakes. So as long as they acted in good faith, what's called the best business judgment, as long as they believe their decision serves the company's best interests and they exercise due care, they did their due diligence, ordinary prudent person would do, then they should be off the hook from liabilities. Now, the business judgment rule does not hold them liable for the company's overall success, but rather their conduct and decision-making process. Simply put, if they acted in the best interest of the company under the circumstances, then they should not be held liable. However, they could face liability for negligent act or omission. Let's assume they fail to secure adequate insurance because they're supposed to, making sure the company's assets are protected, or they hire an unsuitable person without proper vetting. Now, they could properly vet someone and hire the wrong person. That happens all the time. But if they did their job properly vetting the person, and this is what happened when they hire an unsuitable person, the first question is, did you do your due diligence? Did you do your job in looking into the background of this person, their experience, their suitability for the company? Did you check their references? Did you talk to people who they work with? If you didn't do that, then yes, they can be held liable. However, under the business judgment rule, as long as they acted in good faith and in the best interest of the company and they exercise due care, they are in good shape. And there are certain factors that they have to take into account when you are acting in good faith or fiduciary responsibility. You have the right to rely, you have duty of loyalty, and indemnification. It means they're gonna reimburse you. These are crucial in understanding the role and responsibilities of corporate directors. The first thing they would say for the corporate directors, they are entitled that we'll trusted information provided to us. Directors are entitled to trust information, opinion, reports, statements, including financial statements, when these are prepared by internal sources, officers, employee, board committee, that the director believed to be reliable and competent. So if they relied on this is part of their due diligence. They have the right to do that. They have the right to trust this information and act upon it. Also, if we hired an outside source like a legal counsel, accountant, other experts in matters falling within their professional expertise, they have the right to do what? Rely on these judgment and base their opinion based on that. They have the obligation to do what? To be loyal to the company. They must prioritize the company's interests over their personal interests. So therefore, they have to manage any conflict of interest. While directors are barred from competing against the company, they are not necessarily prohibited from engaging in transaction with it. For example, if I am on a board of a company, well, I cannot compete against the company, but I can buy and sell from the company as long as I declare it, as long as I have full disclosure. Everybody approves it. The transaction must be fully disclosed and approved by the majority of the disinterested directors and shareholders. People who have no interest in this, they have to approve it. And it has to be fair. The transaction should be fair and reasonable to the corporation. So it cannot be at the expense of the corporation. Otherwise, you would have a conflict of interest. And the board has the authority to determine compensation for its directors. What does that mean? They put the salary for them. They set the salary for themselves, but they have to be reasonable. They have to think about it. You're kind of setting up your own salary. Usually they form a committee to decide on it. Nevertheless, this committee is setting up its own salary. So you should not have any conflict of interest here. Indemnification. What does that mean? Corporation can reimburse directors for expenses incurred in a lawsuit related to their role as directors, because what's going to happen is if shareholders are angry and they blame someone, the board of directors, for the company's fault or for the company's losses, well, guess what? They need help to do what? To protect themselves, and legal expenses could be a lot. So those reimbursement can cover legal expenses, costs related to defending against a lawsuit. Also, you can be reimbursed for any judgment cost unless that judgment was put forward through a shareholder. So the shareholder had a derivative suit and sued the shareholder. And if they won, guess what? Then the company cannot reimburse you because now the shareholder, the company itself, is suing you. Let's take a look at this multiple choice questions from farhatlectures.com. What does fiduciary duty of corporate directors entails? Well, what's that duty? Is it ensuring that the corporation always makes a profit? That will be nice, but no one can ensure that. Therefore, A is out. Acting in the best interest of the corporation, is this part of the fiduciary duty? I would say B is a good answer choice. Prioritizing shareholder dividend over other consideration? No. You can't do that. Other consideration could be the debtor. You cannot prioritize the shareholder dividend over the debtor's interest. You can't do that. Directly managing our employees, they have no management responsibilities as corporate directors. So yes, acting in the best interest of the corporation is what fiduciary duty of a corporate directors entail. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you whether you are studying for the CPA exam, professional certification, taking accounting courses. Invest in yourself. The CPA exam is worth it. Good luck and stay safe.